This is your Wall Street wake-up call. We're following a slew of economic data this morning, from retail sales to the Consumer Price Index. Ian Weiner, head of equity trading at Wedbush Securities, is with us now from Los Angeles to break it all down. So Ian, June retail sales up 0.6% during the month, beating estimates of 0.1%, largely driven by a pretty steep rise in spending on building materials and gardening equipment.
Yeah, I mean, there's no question that it's a better number. There was also some strength in furniture, strength in autos, and so the consumer's definitely spending a little bit more. I guess the only caveat I would have is that industries like furniture and gardening equipment, and especially autos, are heavily reliant on credit to boost sales, especially to the lower quality consumer. So I would just say that some of those industries have over the last few years taken advantage of very low rates, which seem to continue to allow customers to go into an auto dealership, for instance, and get an 8-year loan with very little interest.
Right, and we also saw gasoline spending up 1.2%. No surprise there, as gas prices are higher. All right, let's shift to the June Consumer Price Index. That is up about 0.2% during the month, missing estimates and sort of in line with the rise we saw in May. Not something the Fed was hoping, right?
No, I mean, obviously they're trying to get prices up. It's sort of that perfect report that a stock investor is looking for, where you have the consumer sort of still plugging along, but you're not really seeing a whole lot of inflation, which keeps the Fed to the sidelines, but gives you a little bit of hope that the economy is not going to go into a recession.
Yeah, well, the interesting part was core CPI, that's less, food and energy, was up 2.3% year over year, so that's above the Fed's target. Of course, that's not the Fed's preferred gauge, but it was interesting to see that. Let's also shift and talk about the markets. What do you make of the continued record highs we're seeing in the S&P 500? It seems odd that investors are suddenly realizing that central banks are here to stay. I mean, that's been a theme for years.
Well, it has been a theme for years. I think the two changes. First, the second derivative of the liquidity is increasing again. That's a change. So now you have rates actually much lower than where they were even when the central bank started this. So, with a 10-year bond at 1.5%, you basically have the argument that you can't be anywhere else but stocks, and then within stocks you have to own high yield stuff, so you see outperformance in the utilities and some of these other higher yielding sectors. The second thing is you've now got the most extreme possible scenarios, where Japan is talking about sort of helicopter money and enormous fiscal stimulus, and I think that people are hoping for that in addition to monetary stimulus in order to kind of prop up the market some more. So I think those are the two big changes that are leading us to higher highs, and add to the fact that a lot of investors are synthetically short or not involved in the market, and there's some performance chase anxiety, especially among hedge funds who are lagging the S&P again for what seems like the 6th or 7th straight year.
Yeah, well, and do you see more record highs in the coming months?
Well, I mean, I'm missing the rally. I'm in cash, as I said last week.
Sure.
So, shame on me for missing it. But yeah, I mean, I think that earnings season is going to dictate at least where we go from here. I think we get the crux of that the next 2 weeks. I still think that the S&P estimates for next year are too high at 14% earnings growth. And so, what I think is going to happen is, we're going to get into the meat of reports. I think companies are going to be more cautious on their outlooks, and I think we're going to run into a brick wall right around this level, 2,200.
All right, well, you heard it right here. Ian Weiner, head of equity trading at Wedbush, thank you so much for joining us.
Thanks for having me, Scott.
I'm Scott Gamm, and you're watching The Street.